Welcome. This video is going to discuss the option pricing Greek known as gamma. If you'd like to follow along on optionsplaybook.com, please go to the search tab and search for the section called Meet the Greeks. Inside that section, you'll see all the definitions that I'm going to use today and a few of the graphics that I will talk about. Gamma, it's the rate of change of delta. Doesn't tell us very much except for the fact that if you're going to talk about gamma, you need to understand delta. And fortunately, we've already done a video on delta and went to extreme length to explain how important delta is in the options pricing world. As a matter of fact, it's so important that they gave it a sidekick, and that sidekick is known as gamma. So let's start by defining both of these Greeks. If you go to the section called Meet the Greeks, you will see the definition of delta, and then below that you will see the definition of gamma. The definition of delta on a textbook basis is the amount an options price is expected to move based on a $1 change in the underlying stock. On a textbook basis, the definition of gamma is the rate that delta will change based on a $1 change in the price of the underlying stock. The way I think about delta and gamma is that if you think of delta as the speed of your option contract, gamma would then be the acceleration of that option contract, how fast that delta will move as the underlying stock goes in and out of the money and as expiration approaches. Now, we've gone through a scenario in the delta video, and we basically defined gamma in that video. We just didn't call out the fact that that rate of change of the delta is known as gamma. So in this video, I'm just going to go through the one graphic that we have in the Meet the Greek section that just shows you how a longer term options delta moves based off of the gamma relative to a shorter term option contract. And bottom line is, if you look at delta, the most at the money option contract in a specific expiration, in theory, is going to have a delta fairly close to 0.50 or 50 cents, meaning that if the underlying stock moved $1 and it was a call option and it moved up, that your option contract should move up by 50 cents. And if it moved down $1 and it was a call option and we had an at the money option contract, that your option contract should go down by 50 cents. Well, while that is happening, that delta is dynamic and it's changing and it's moving. So in our example that we have, we're showing the stock at 50. We're showing the strike of 50, and it is a call option on a fictitious stock called XYZ. And we show that here's how the delta moves as that underlying stock goes in the money, and then how that delta moves as that underlying stock relative to the option goes out of the money. So to start with, on the first point movement on our 60-day option contract, we see the stock goes from 50 to 51. Our delta goes from 50 cents to 60 cents, meaning that our gamma was 0.10. So gamma said that the rate of change of delta was 10 cents, and we saw that in the movement of the delta. Now we're getting further in the money on that option contract with the stock at 51. So in that next point movement, when the stock goes from 51 to 52, we see that our delta went from 60 cents, now we're getting deeper in the money, so it's going to increase, and it went to 68 cents, implying that the gamma was a little bit smaller than it just was. And instead of a 10-cent movement in delta, we're seeing an 8-cent movement in delta. And the scenario is the same if the underlying stock goes down. When the stock goes from 50 to 49, we had a delta of 50. Gamma was still 10 cents. It doesn't have any regard to direction. So the delta went from 50 cents down to 40. And then when it went from 49 down to 48, we saw that our delta went from 0.40 down 8 cents to 0.32. Now, that's on a 60-day option contract. But the moral to the story here, or the theme to take away from that example, is that if you're looking at delta, the most at-the-money option contract for that expiration will usually have the highest gamma. We know that delta can range between 0 and 1 if we're talking about call options. And it just makes sense if you start to think about it that as you get to an extreme, so in our example, the stock went from 50 to 51 to 52, and the delta is getting bigger and bigger. Well, the delta can't go beyond 1 because by definition, it can't. You can't receive more for a derivative than you would if you bought the underlying that it's derived from. So as we get closer and closer to 1 on the delta, the gamma's got to get smaller and smaller because it can't push delta beyond 1. And then on the other extreme, as we get further and further out of the money, the delta is getting smaller and smaller, and gamma cannot push delta beyond 0. All right. So takeaway from this one is that the most at-the-money option contract is usually the most explosive option contract in regards to delta. Now, if we go to the other extreme, which we did in the delta video also, and we talk about a one-day option contract. Now you're looking at a very extreme delta and gamma combination, if you will. So if the stock is 50 and the strike is 50 and you're right at the money with only 1 day remaining to expiration, your delta is still going to be fairly close to 50. And if that stock does move, though, gamma is going to say that delta is going to explode in either direction. If the stock goes up 1, gamma in our example here says that the delta is going to move by 40 cents, 0.40. So if the delta is 0.50 on that at-the-money 1 day option contract, the stock goes up 1, and now our delta is going to be 0.90, meaning that for every point the underlying stock moves deeper and deeper in the money, this option contract is going to act a lot like that underlying stock. So in our example, once again, we went with the stock at 50, it goes to 51, the delta moves by the gamma, which is 40 cents, so that means that the delta is now 90 cents, and then when it goes from 51 to 52, we see that our gamma got smaller, and we see that our delta is now almost 1 at 0.99. Same scenario on the downside. Stock goes from 50 to 49. We see that our delta goes down by the amount of gamma, 40 cents, and we see our delta is now at 10 cents. Goes another point, we see the delta get all the way down to 0.01, meaning that gamma got a lot smaller because it cannot push delta beyond the extreme. Okay, so now we know why gamma is considered the rate of change of delta. But I'm going to be blunt with you in that if you've been trading options for years and you've never received a quote on what your gamma is for the option contract that you've sold or bought, that's okay. And if you never receive a quote on the gamma for that option contract, as a retail trader, that's not that big of a deal. What I want you to take away from this video is the concept that gamma becomes very explosive on delta as expiration approaches, and it is the biggest number for that at-the-money option contract within that expiration. So, on my days on the Chicago Board Option Exchange, there was a lot of debate about the last week to expiration on any option contract. They actually referred to it, the market makers on the floor, as gamma week. And if you were short option contracts, and let's say you were selling an option contract with just a few days to expiration, there is a lot of risk because you don't usually receive a lot of time premium, especially if it's an out-of-the-money option contract. And if it gets in the money, you get that surprise move. It moves against you so fast. And why does that happen? Because Gamma says that it does, right? So in that last week to expiration, a lot happens if you're buying option contracts and they're not quite getting in the money, or you're selling option contracts and you get surprised and all of a sudden they're in the money. Gamma creates risk. And that risk is a real thing if you are trading options in the last week to that expiration. And this is more and more important because of the plethora of different expirations that we have. We have weeklies, we have dailies, otherwise known as 0 DTE option contracts. Those option contracts are very popular. They are traded very heavily. And those option contracts have a lot of gamma risk. And that's the main takeaway of this video. Thanks for viewing. If you'd like to learn more, please go to optionsplaybook.com. And if you have any questions, please email us at support@optionsplaybook.com.